Shares post says Facebook's value has grown from $11 billion last year to $54 billion. Is that right? Can we believe the secondary market froth? Andy Kessler knows something of froth, former hedge fund manager, sell-side analyst, venture capitalist, holder of some pretty good Warriors tickets, and author of Eat People.
Yes. A
couple of great books. Eat People, another great one in the list here. You've seen this stuff before, but we haven't seen this secondary market trading by private individuals. Your thoughts on the valuation of Facebook at $54 billion? It's got to be real, right?
Well, valuations are whatever they want to be, right? They're in the eyes of the, well, I was about to say beholder, but in the eyes of the deceiver. There's no information out there. I mean, the reason that there are regulations for public companies to disclose what their quarterly earnings are and share count and all those kind of things so people can make rational decisions what the valuation is. Here, there's no market. There's not enough sellers and too many buyers and not enough sellers, so valuation goes to wherever it wants to. It's too thin.
Securities law sort of says, hey, these are rich people, accredited investors.
Sure.
They can do what they want.
They can lose whatever money they want.
Does that mean that they're supposed to be smarter?
Well, I mean, it's just so because some Russian oligarchs and Goldman Sachs' wealthy clients want to go bid things up to $50 billion, and maybe Facebook is worth $100 billion, and it's the greatest investment ever. But what I have a problem with is that, you know, the Sarbanes-Oxley and other rules have held back IPOs. There should be more IPOs, not less IPOs. I don't want to go back to the froth of 1999 where all you had to do is declare what your business model was and you can go public because you gave AOL some money, et cetera. But I want to see the barriers to entry to going public lower. So a company like Facebook does go public, and the venture guys sell their shares to the public shareholders, and they meet in the middle, and you figure out day by day, tick by tick, what the right price is. Facebook may be worth that. Some of these other names, I'm not so sure. We don't know what the business model, we don't know what the revenue stream is. It's tough to tell. Buyer beware.
Andy, sometimes it seems with all the enthusiasm to be part of these second markets that it's like the wild, wild west out here. I mean, do you think that there should be more transparency with these deals?
Well, sure, but I mean, if you're one of these companies, why would you want to have transparency? Why would you want to have other companies to know what your revenues and profits and models is? You can't help having these shares leak out. It's from shareholders who, you know, employees who've been with the company a long time. Well, so what? So the shares are out there. But again, what I'd rather see is I'd rather encourage these companies to be part of the public market. Look, stock markets are about access to capital. And so if Facebook needs $1 billion or $5 billion to build data centers near waterfalls and you know, to stream freaking excellent movies to their consumers, that's great. But let's use the public markets, because the public markets are a lot more honest than these private, very thin, non-transparent markets.
The SEC is looking into these secondary markets. Do you think that regulators should actually step in?
Yeah, but, you know, you don't want to stop, you know, two adults from doing transactions with each other. I think instead is change the rules on the existing public markets. Encourage these companies to go market. Don't restrict private shareholders from selling to each other. Rather, encourage them to use the public markets, which are a lot more honest. I mean, the U.S. market is one of the most honest in the world. Let's use it.
It's kind of interesting that the irony that Sarbanes-Oxley was in some ways a reaction to the .com era when anybody could go public, when lots of companies that were, as Warren Buffett says, you know, there are innovators and then imitators and then idiots. Yeah. Lots of idiots went public. Sarbanes-Oxley was meant to protect idiot investors from idiot companies or crooked companies. Right. But you're right, it kind of stopped up the works, and now you've got the companies not going public, not disclosing financials, and still selling stock.
It's classic unintended consequences of legislation and regulation. Let's go back the other way. Let's encourage transparency. Why do we only have quarterly earnings from companies? I want more information. Give me a fire hose of information. I mean, I want to see Facebook's models on how they think they're going to stream movies over time and what that can mean in terms of a revenue stream. And if it's going to be a terrific business, I doubt it, by the way, but if it's going to be a terrific business, great. I'll pay $100 billion if I can rationalize that they're going to make $10 billion in profits somewhere down the road. But I can't do that today because the information is stopped up. It's stuck somewhere. It's stuck in these private markets. And I think a lot of it, again, is because stupid regulation. You got to start unwinding some of these stupid regulations and encourage transparency.
One of the other things that we're seeing is the IPO cycle has gotten longer. For example, Kayak and Skype filed last year, but that still hasn't happened. What kind of risks does that pose?
Well, I mean, it's risk to the the venture business and the funding of innovative companies. I mean, look, it's frothy out here in Silicon Valley. A lot of money is being thrown at, iPhone app companies that may or may not deserve it. But the fact that the exit strategy or the liquidity event or the ability for companies to have their value set by buyers and sellers every day, the more that gets pushed out, the worse it is. Some of those, like Skype, there's still some issues about who owns what kind of intellectual property. My understanding is it's a little bit of a mess, and a lot of those things have to be worked out. But again, I think the less companies that are in the public domain, the more damage is potentially done by the lack of transparency and the ability for either some fraudster or just someone overpaying by 2x and loses a lot of money because they're chasing money in these private exchanges.
I can't believe you think companies would be frauds. But let me, real quick, I don't want to let you get out of here without talking about Eat People. And
yeah.
What's different about this bubble, this technology interest than we've seen in the past? And how do you get that in Eat People?
Yeah, so what I'm a big fan of is finding technology that creates productivity. Productivity means output per worker hour. It's the only way that you can create wealth in society. It's the only way to increase standard of living. You can't print money in the basement of the Federal Reserve and create wealth. It just doesn't happen. It has to come from productivity. Fortunately, it is companies like Facebook and Twitter and Groupon and Netflix and all those that are doing those kind of things. And in each one, sometimes it's a stretch, but in each one you can find where people got taken out of the equation, right? We got rid of telephone operators and tellers and now stockbrokers and stock traders, but increasingly it's going to go up the food chain. We're going to get rid of sales and marketing people. We're going to get rid of lawyers and doctors and hopefully not TV hosts.
Anchors, hosts, sidekick.
The opportunity for companies to do those things is outstanding.
Andy, author of Eat People, really appreciate your joining us. We can talk for days, and we will.
Thanks for having me.
In the future.